Let's bring up on the screen, if we can, Scott Kaufman. There he is, the CEO of Creek Road Miners. Scott, how are we doing today?
I'm doing very well. Thank you. Thank you so much.
All right. We have slides. We have them up. There they are.
Fantastic.
Nice. We're talking Bitcoin mining. I love it. The floor is yours, sir.
Fantastic. Thank you. And again, thank you everyone for joining us today. Creek Road Miners is a cryptocurrency mining company. However, we are a cryptocurrency mining company with what we feel is a differentiating objective that we are striving to achieve by utilizing our Five-Cornerstone Strategy. Now, that's a lot of words. So delving in, what is our objective? Our objective is quite simple. It is to utilize our own energy to power data centers that will mine for cryptocurrencies, enabling us, Creek Road Miners, to build a diversified portfolio of cryptocurrencies. Again, quite simple. Use our own energy, mine for crypto, build a portfolio. This is what our objectives are. This is what we are trying to achieve. How did we develop this objective? It really came from studying the industry, and we decided to start with mining for Bitcoin. And I think in understanding the industry, you needed to understand what it is you cannot control as well as what it is you can control. And obviously what we cannot control is how many people are mining for Bitcoin. What is the network hash rate? Of course, what is the price of Bitcoin? What is the block rewards, as well as what is the cost of the machines? Again, things we cannot control. But focusing on what we can control, at least do our best to control, obviously it's the cost of electricity, the number of miners. I mean, in essence, how much money do you have to buy the miners and what methodology do you acquire these miners? You do your best to control the continuity of mining. Basically, you want to make sure you don't have shutdowns. And then, of course, you can control your internal expenses and overhead. Those are the things we can control. And by studying these aspects of the industry, we developed what we call our Five-Cornerstone Strategy. What are they? The first is vertical integration. Very simple. It's owning the whole process. It's owning the whole process from energy generation all the way up through the production of cryptocurrency mining. One. The second, energy diversification. Basically, it means having multiple energy sources providing energy to one facility, as opposed to having one large infrastructure piece providing that energy. The third cornerstone is geographic distribution. Very simple. Would rather have 10, 50 megawatt facilities as opposed to one large 500 megawatt facility. The fourth is cryptocurrency diversification. I think we all understand that Bitcoin and Ethereum are the staples of today's industry, but who knows what tomorrow will bring? This industry, from our perspective, is in its infancy. And the fifth in cornerstone strategy is revenue diversification. We feel that there need to be other forms of revenue generated by our company, other than that related to Bitcoin, as a means of covering operating expenses, enabling us to maintain treasury status with our coin. Summarizing each of the five, let's delve into them each a little bit more detail. Again, the first is vertical integration. Again, the concept of owning the whole process, owning it from production, all the way, energy production, all the way through the cryptocurrency production. By doing so, Creek Road is going to do its best to maintain control of its continuity, profitability, while decreasing potential regulatory risk that we see coming through into the industry. Let's focus on continuity first. The concept, again, of continuity is making sure that your miners are running, full stop. It's the first and foremost component of continuity, is making sure you actually have the energy. In studying the crypto marketplace, we identified many scenarios where larger companies went out, acquired switching stations, which means that they acquired the physical location where the energy was to be received, but did not own the energy, spent tens of millions of dollars, built out infrastructure next to said switching station, set up mining operations, and began mining. But then one day, the energy stopped showing up. What wound up happening is they had to move locations, spend another tens of millions of dollars to build new infrastructure, and off they went mining again. But because they did not own the energy, they fell subject to that. The second component is making sure that we have a constant flow of energy. Okay? I think that most cryptocurrency companies that we've been able to identify in some way or fashion either provide and or take energy from the electrical grid. And then we believe that it is subjecting themselves to potential continuity issues. I'm sure we're all very familiar with the roaming blackouts in California. And in fact, there's a lot of discussion in the media about the energy shortages in other states, and roaming blackouts will start in other states as well. By owning our energy, Creek Road is going to do its best to maintain its continuity and isolating itself from these issues. What I mean by that is right now, as we are on this conference, we are currently taking natural gas from a wellhead and sending it directly to our mining operations without touching any infrastructure. Literally, we could get on a plane and go visit our facilities, and you can stand on a 6-by-6 foot graded platform with a wellhead coming out of the center of it, looking down into the waters of the bayous of Louisiana. And you can stand next to this wellhead, and you can hear the natural gas come out of the ground. You can hear the pings of the oil hitting the flow lines. Okay? Again, this oil and natural gas hasn't seen the light of day in over 350 million years. And as you peer over your left shoulder, you can see our aggregation facilities where this natural gas is running to directly into our turbine. Don't touch infrastructure. Don't touch anything else but the systems that we have in place. Again, this vertical integration ensures continuity by the fact that we own this energy and directing it to where we want. And by the way, we also don't have to worry about a stressed infrastructure that is potentially leading to regulations. Again, that's something we'll talk about more in a minute. The second part of this vertical integration is profitability. And there are two components to profitability. And first is the simplest, in that by vertically integrating, you eliminate a lot of the middlemen. For example, when you buy miners, as we do directly from the OEM, you don't have middlemen. When you produce your own energy, there is no need for the energy producer themselves to make a profit. All this added capital goes directly to our bottom line. It streamlines our process, and this obviously has a direct impact on our income and cash flow statement. Okay? Again, we are doing this now. But there's another component of profitability, and I call this the disconnect. It does feed into regulations as well, which we'll touch on in a minute, but the disconnect is actually quite simple. As we are doing today, we are taking energy, 1 MCF of natural gas, let's say, that we could potentially sell into a pipeline for a hen hub of roughly $4. By redirecting that 1 MCF and running it directly into our operations, we are generating roughly $30 of crypto on that same MCF. Let me say that again. Instead of selling something for $4, we are running it to our turbine and generating over $30 of crypto. It is over 7 times return, literally by changing 4 bolts and redirecting the energy from the pipeline to our turbines. So where this benefits Creek Road and our endeavors to physically own the assets, right, this also helps us from a valuation perspective. And let's look at that, again, by vertically integrating. And let me give some leeway here. Let's talk about an example where there's a facility that has 10,000 MCF of natural gas production a day. An institution that has 10,000 MCF and sells it into the pipeline for $4 an MCF generates roughly $40,000 a day, $1.2 million of monthly revenue, or roughly $15 million a year of revenue. But by taking that natural gas and running it into our turbine and generating $30 per MCF, we're not generating $40,000 a day. We're generating $300,000 a day of crypto, $9 million a month, or roughly $111 million of annual revenue. Now, there's a big VIG in there, and please, all disclaimers, and that's making the assumption you're utilizing 100% of the natural gas, but there's a big difference between 15 million and 112 million. You can be wrong by 50%, 75%, even 80%, and this concept of this vertical integration of us owning energy makes sense. We are looking to find these natural gas assets, acquire them at this oil and gas valuation, rolling them into our entity, and taking advantage of that valuation. However, this also then leads us to the regulatory environment. Right? I do think that cryptocurrency companies do not want a press release, nor do the municipalities, nor do the energy companies would like a press release stating that given the roaming blackouts, local hospitals, local schools shut down because of a roaming blackout, juxtaposed to the cryptocurrency mining operation having its energy and operation. I don't think they want to deal with that. We avoid that by owning our energy. The second issue with regards to regulatory is a little bit more in depth and more involved. I think simple economics states to us that if you can buy something for $4 and turn it into $30 of revenue, one of two things has to happen. The price of the raw materials is too cheap, or the finished good product is too expensive. Well, you have very little control over that $30 of that cryptocurrency, which theoretically means that the price of the energy itself has to come up in value. If price of energy comes up, that would be devastating for society. And we're talking 2, 3 potentially multiples on the price of the energy, which means in some way, fashion, or form, there should be some regulation coming in with regards to either subsidies or the quantity of energy that comes out of the grid that is touching this energy and impacting cryptocurrency mining operations. By us owning our energy and by us vertically integrating, taking energy out of the grid, not touching this regulated infrastructure, we have done our best to maintain continuity, and will do our best to maintain continuity, impact ourselves from a profitability, and to do our best to avoid regulatory risk. Again, our energy doesn't touch infrastructure. So the vertical integration play is key from that perspective. And in fact, it is our largest component of our cornerstone strategy. I touched on other aspects of our cornerstone strategy. The second is energy diversification. As I mentioned earlier, we would rather have multiple wellheads, 10, 20, 30, 50, 100 wellheads, providing energy to one facility, as opposed to having one large piece of machinery, whether it's a turbine, whatever it is, providing energy to one of our facilities. Why? If the hydro plant goes down, all of the energy is gone. However, if we have 400 or 500 wells providing energy, if one of them goes down, it's okay. You have continuity. You're still okay with your production. The third cornerstone is geographic distribution, where it might be a little bit more expensive. The margins associated with cryptocurrency mining are very high. But as a means of maintaining continuity, again, we'd rather have 10 different facilities, each with 10, 20, 30 megawatts of power, as opposed to one 300 megawatt facility. Again, because if the 300 megawatt facility goes down, there's an issue. Cryptocurrency diversification. Another cornerstone. As I mentioned earlier, we think that we are in the embryonic stages of the industry. I almost equate it to a baseball game in that the national anthem has been sung and the players are running out of the dugout. Bitcoin and Ethereum are the staples today. And as we lean over the bow of the ship and watching the topography change in this cryptocurrency mining universe, you need to be flexible. You need to understand which coins in the future are going to be maybe join the Bitcoin or join the Ethereum, but you need to be flexible to be able to maintain production of your staple coins, but also move in and out of cryptocurrencies that might be in favor for a day, a week, a month. It is essential to have cryptocurrency diversification. And the last cornerstone is revenue diversification. We feel that by owning oil and gas assets in conjunction with our cryptocurrency mining operation, we can utilize the revenues that we generate from the other commodities to cover all of the operating expenses associated with our cryptocurrency mining operations, enabling us to maintain treasury status with all of our coin. Simply put, what we're saying is we'd like to drive revenue from other streams, other commodities. So every single cryptocurrency that we do mine, we have full flexibility to do with it what it is that we would like to do. Whether it's hedge it, sell it, we want to make sure and maintain our flexibility with it. Those are the 5 cornerstones that we are building Creek Road on and striving to meet our objective. Everyone talks about ESG as well, and we're doing our best to be ESG compliant. I mean, as we are in our embryonic stage of an entity, we are using natural gas and we're collating our facilities as a means of not having massive distances between any of the transportation. That's what we're initially doing. We are looking for phase 2, stranded gas opportunities, and of course, we're going to move into renewable energies, leading potentially to a phase 3, carbon capture. In fact, we are looking at hydrogen production facilities. And in fact, I had a very interesting conversation with an embryonic stage nuclear company. So again, in looking at ESG, we also firmly believe that with ESG, look, we would love there to be a totally green environment today, but it's going to take time. And as long as we all have moderation, we feel that we'll be focused on it. It is at the forefront of what we're doing in relation to us implementing our cornerstone strategy. So in summary, Creek Road Miners' differentiating objective is to utilize our own energy, mine for crypto, build a diversified portfolio by implementing it through our 5 cornerstone strategy, vertically integrating, diversification of energy, locations, cryptocurrencies, and dual revenue streams. Which begs the question, this is our objective, but the question is where are we today? And what have we accomplished so far? This is an embryonic stage company. We are 6 months old, but we've accomplished a tremendous amount. And what I mean by that is that if you look along the flow line and timeline of what we've accomplished, we have not only developed the strategy and the objectives, we have not only acquired miners directly from the OEM and actually had them delivered. We've acquired the facilities to operate them. We've acquired our energy source. We've acquired our turbine. And as we sit here today on the phone, we have our proof of concept facility operating, sitting on a floating barge in the bayous of Louisiana. It's a very, very interesting operation at this point. It took us 22 hours from start to finish to install a 1 megawatt facility. And literally, as we are on the call here today, we can unscrew 4 bolts, remove a 4-inch flex line, and we have a mobile unit, whether it be on land or on water. And as we have publicly announced, we have ordered additional containers. We have ordered additional miners. And what Creek Road Miners needs now is just time to continue to grow and to deliver on its 5 cornerstone strategies and move forward. We can talk a little bit about the economics. I'm sure this is a slide that most people have seen, basically talking about the revenue, of course, with mining for Bitcoin, our cost of natural gas, turbines, operating expenses, gives you your profit and loss. Here's an example of one of our most recent operations that we installed. We acquired 270 miners, acquired a container, roughly $2.5 million of CapEx expenditures. And this is how we're operating today. We have a 75% gross margin at a $50,000 Bitcoin price. Our energy costs, which is just the cost of the natural gas, as well as it's natural gas, we're running at about sub 3.5 cents per kilowatt hour. And our cost to mine a coin is roughly $5,200. You'll notice, though, I state that this is without full strategy implementation. Because again, when I talked about vertically integrating, if we were to own, and when we will own, a natural gas and oil producing company, the profits associated with mining for drilling for oil and natural gas go directly to our bottom line, which theoretically will reduce our energy costs anywhere from 20 to 60%. And we firmly believe that over time and by full implementation of the strategy, we can get our energy costs and our cost to mine much cheaper, at least 50% less than what it currently is today. So again, as we sit here today, we have a very interesting differentiating objective. We're currently operating Bitcoin mining operations. We are expanding our footprint. We are expanding our geographic locations, and we are looking forward to continued growth with both additional facilities, as well as implementing on all of our 5 cornerstone strategies and achieving our ultimate objective of owning the energy all the way up to owning the cryptocurrency mining operations. So saying that, I'm not sure how much time I have left, but I'll
actually we're at time, Scott. You went right up to the clock. So we appreciate the insight, Scott Kaufman, as it says there, CEO of Creek Road Miners. Scott, thanks a lot for all the information, a lot to think about here, and thanks for coming on the Benzinga Small Cap Conference today. Have a good one.
Thank you so much.